I saw Steven Spielberg made some comments over the last couple of weeks about, okay, producing movies is going to be dramatically cheaper, right? Because the technology is getting cheaper and cheaper. We can do really advanced things in terms of special effects and AI generated movie content that is going to be cheaper and cheaper, right? But is that going to increase the demand for movies? Not obvious. Not obvious. I think we are going to have these efficiency gains, and the additional profits are likely to go to a significant degree to some very, very big players, as we've already discussed. And therefore, in very simple terms, it's going to be a sort of part of greater inequality unless governments do something to intervene, right? So people who analyzed AI for not just in the last couple of years where it entered the mainstream, but thinking about AI from a more big picture, long-term perspective, they made the point that AI needs to be coupled with a basic universal income, right? Because it's going to create competition for a lot of low-end occupation and services. We need to actually have the government step in and provide basic income to those groups. So that's obviously a political decision to do so, right? But that's kind of like shows you that if we have the benefits, the profits of this technology deriving to a very small group of people, it could really be harmful to the ones that have previously had the jobs that are now getting out competed. And if there's no government intervention, that I think you can argue from a consumption perspective is actually negative for consumption, right? Because Jeff Bezos or somebody like that is not going to consume a heck of a lot more just because Amazon does better. Whereas at the lower end of the income distribution, the propensity to consume is much closer to 100%. So I think those are the effects to think about. But maybe we can talk a bit about productivity as well, because I think that's something that is relevant for macro, right? So when we've been thinking about interest rates, right, and I speak to institutional investors around the world all the time, right, and we've had a huge debate, argument, or whatever we want to call it, about interest rates over the last couple of months, right? So there's two main arguments that interest rates could be high. The one argument is the one we've already talked about a little bit, to do with supply, right? Okay, we have fiscal deficits, we have a lot of supply, there's some demand that is less robust from foreign central banks and so forth. That creates kind of risk premium. Interest rates need to be high. That's number one. Number two is the AI dimension that has to do with productivity, right? If you think we're entering an era where productivity growth is going to be dramatically higher, then that is also going to have an impact on what you think equilibrium interests are. This famous or infamous concept of our star, equilibrium interest rates, and most people argue that there's some kind of link between productivity growth, structural growth, equilibrium growth in the economy, and what that equilibrium interest rate is. And we've now, over the last 15 years, been through a period of very low productivity growth. Call it 1%. Right, so the growth we see in GDP is a function of whatever kind of demographic growth we have, and that labor productivity growth, and it's been incredibly low. If you go back to the early, call it mid-90s, we have very, very strong productivity growth, and like in some years 3 to 4, right? So it's not like a little bit higher than what we have been used to in the last 15 years, but like multiples bigger. So the ones who believe that interest rates might go a lot higher, the ones that think that the AI effect is gonna actually be so powerful that it might lift overall productivity in a very meaningful way. So I work with AI within Market Reader. I think it's fantastic. It's really opened up analysis, different opportunities in terms of presenting content to a big audience, generate real-time insights, but also like just filtering information in these fussy ways that you cannot do with quant models. So it's fascinating and it's exciting, right? But if I put on sort of my economist hat and think about, okay, how's it going to really impact the macro? We already talked about, okay, from a consumption perspective, we might have a situation where the wealth kind of falls in a very unequal way, and therefore consumption is not going to be so supported. But I think there's also a time frame issue. So when you ask CEOs about, okay, when will they harvest the fruits of these AI investments, most of them say in 3 to 5 years' time, right? So it's not something that is going to be like a big boost on January 1, 2024, right? It's going to come with a lag. And it might be that we're looking into 26, 27, where before we can really see it in productivity. So in terms of how interest rates are set right now in the market and how the Fed is going to think about interest rates, it's going to be hard to really have conviction that these AI effects is going to totally dominate GDP figures and so forth. Like, we have incredible cyclical swings still from COVID effects, stimulus coming out of the equation and so forth. And those effects have been enormous. And I think in the short term, together with the lagged effects of just having risen rates, is probably going to dominate. And the other argument, even if I believe strongly in AI, has to do with this notion, and they actually spoke about that at Jackson Hole, the notion that it's harder and harder to squeeze extra productivity out of anything. Like, so even if AI is fantastic, even if it is a revolution that's going to allow us to do new things, the sort of counter argument is that if we hadn't come up with AI, productivity would have gone even lower, right? So it's a counterbalance to this problem that is harder and harder to generate productivity gains. So I think we're probably going to get a boost to productivity growth in coming years. But if we think about us coming from 1%, and the sort of peak of productivity growth in the mid 90s was 3 to 4%, I think we're going to have a lift from 1, but I don't think we're going to get close to 3 to 4%, right? So maybe we're going to get to 1.5 if I'm going to just put numbers out there for illustration. This is not precise science, but that would be my best bet, right? And that's sort of a U.S. thing, right? So if you think about where interest rates are heading, it matters whether productivity growth is 1 or 1.5, right? But it's not going to like totally change whether we need, 0 interest rates or 5% or 10% interest rates. So from that perspective, it also shouldn't be seen as the only force that is driving yield curves and markets. There are other forces, like if I can just mention one, right? We've had a 30-year boom in China that is now turning into a very severe structural challenge, right? So China is kind of going through the opposite, if you will, right? That's also something that's going to matter for growth on a global basis and drag in the other direction, irrespective of whether they're good at AI domestically or not, right? So the cyclical forces can dominate in the short term, even if there's structural shift that goes in the other direction.